Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is your host, Jordan Goodman. My guest this hour is Richard Duncan. He is the publisher of the Macro Watch newsletter. He's the author of several books, one called The Dollar Crisis, another one called The New Depression, and he has a newsletter that describes all kinds of global economic situations. Welcome to the Money Answer Show, Richard.
Jordan, thank you for having me on.
Just give us a bit of your career leading up to what you're doing now so people have a sense of your background.
All right, so I grew up in Kentucky, went to Vanderbilt, ended up backpacking around the world immediately after that, and I saw Asia in early 1984. And Asia was booming economically. And so I realized, go east, young man. So after a couple of years in business school in the U.S., I flew to Hong Kong and found a job with a stockbroking company and became a securities analyst and have spent most of my career in Asia since 1986, working for stockbroking companies, also fund management companies. Eventually, I worked for the World Bank in Washington for a couple of years during the Asia crisis, and later became the global head of investment strategy for ABN AMRO Asset Management based in London, looking at all asset classes globally. And along the way, I've written 3 books on the global economic crisis, and now I produce Macro Watch, which is a video newsletter.
Very good. And people can find out more about that at richardduncaneconomics.com. So let's kind of take a look at the overall picture here. Kind of describe the state of the world economy before the coronavirus hit, and then we can talk about after it hit. But talk about where we stood before the virus hit.
Well, so before the virus hit, the U.S. economy was in reasonably good shape, not really very good, but okay. But you have to keep in mind that the Fed had relaunched quantitative easing back in September. QE4 started in September. And from October onward, they were creating $60 billion a month. So QE4 was supporting the economy. And also recall that last year the government's budget deficit had climbed up to $1 trillion. So the economy was getting a lot of support from both the fiscal side and the monetary side. And it was still just doing just okay rather than really booming. Okay,
and then the coronavirus hit in the United States basically in kind of February and March, and then got more intense. And it was really kind of a surprise. People were not really prepared for it. What was the economic impact of the coronavirus?
Well, so I think here it's useful to understand that our economic system works very differently now than it did in the past. I mean, back in the days when money was actually backed by gold, up until, let's say, 1971. So since that time, credit growth has become the major driver of economic growth. So if you look back even to 1950, anytime credit in the U.S. adjusted for inflation grew by less than 2%, the economy went into a recession. And the recession didn't end until another huge wave of credit growth occurred and pulled the economy out of a recession again. And so that happened 9 times between 1952 and 2008. And every time credit grew less than 2%, the economy went into recession. So our economy, total credit in the U.S., and by total credit is the same thing as total debt. One person's asset is another person's liability. That's government debt, household sector debt, corporate debt, financial sector debt. All the debt in the country first went above $1 trillion in 1964. And by 2007, it had expanded 50 times, from $1 trillion to $50 trillion of debt in just 43 years. And so it was that credit growth that generated the economic growth in the U.S., and the U.S. growth helped fuel the global economy. but ultimately it blew into a big economic bubble, and when the private sector couldn't repay its debt in 2008, that bubble started to implode. And the government at that point had to respond with enormous budget deficits, topping more than $1 trillion a year for 4 years in a row. And the Fed had to jump in with quantitative easing on a massive scale. They created $3.5 trillion between 2007 and 2014. And to put that into perspective, during the first 93 years of the Fed's existence, it had only created $900 billion. Over the next 7 years, it expanded the amount of money it created by 5 times. So it went from 900 billion to 4.5 trillion in just 7 years. So that extraordinary expansion of monetary policy helped finance the massive fiscal stimulus, and that prevented the economy from collapsing into a depression in 2008 and generated growth in the 12 years between that crisis and this crisis. And the economy, unemployment was extremely low. And the most interesting thing that we learned from that, or the most surprising thing, is that all that money creation by the central bank in the US and other central banks all around the world, it didn't lead to high rates of inflation. We were all taught that if the central bank creates a great deal of money, then it's inevitably going to lead to very high rates of inflation. But as I just mentioned, the Fed's balance sheet expanded by 5 times, and the Fed was more concerned with deflation most of the time since 2008 than it was worried about inflation. So
why did it not create inflation? I mean, this was not only happening here, but this was happening with central banks around the world. The ECB and the Bank of Japan and China, they were all printing money as well. So why has this not caused the inflation that Milton Friedman would have predicted?
Right. He said inflation is always and everywhere a monetary phenomenon, but it's not, because there are other factors that also affect the price level. And the dominant factor in the world today affecting prices is globalization. Mm-hmm. In the past, back in Milton's day, the U.S. economy was a relatively closed domestic economy. The U.S. didn't have big trade deficits up until the early 1980s. Before that time, when we were on the Bretton Woods system, trade between countries had the balance. But once the Bretton Woods system broke down, the U.S. discovered that it was able to buy things from other countries and pay for those things by giving them U.S. government bonds. And so by the mid-1980s, the U.S. had a trade deficit equivalent to 3.5% of U.S. GDP, which was entirely unprecedented. And by 2006, it had grown to 6% of GDP. And what that means is, back in Milton's day, if the U.S. government had a very large budget deficit, and if the Fed created a lot of money to finance that deficit, then very quickly all of that stimulus would have overheated the U.S. economy. It would have led to full employment and full capacity of full utilization of the industrial capacity in the steel mills and the car plants, for instance. And pretty soon, with full capacity of labor and industry, that would lead to higher inflation. Wages would begin to spiral upward, and the cost of manufactured goods would also spiral upward.
Which is what happened in the late 70s, right? That's basically what happened in the late 70s.
That's right. But now things are very different, because our economy is no longer a closed domestic economy only comprised of the American public. It's now a global economy. And in the global economy today, there are nearly 8 billion people, 2 billion of whom live on less than $3 a day, who would probably feel lucky if they could land a job earning $10 a day. And so this has been extraordinarily deflationary. It's put extreme downward pressure on wages in the U.S., and at the same time, there's a tremendous glut of industrial capacity all around the world because of China's industrial capacity. They have an enormous economic bubble there.
So you're saying that the deflationary forces of globalization, in effect, were stronger than the inflationary effect of all this money printing around the world?
That's right. The deflationary forces of globalization offset the inflationary forces that would have resulted from all of the money creation and the huge budget deficits that we've experienced since 2008.
And that's not going away, right? I mean, the globalization is not going away. There may be some threats to it, but it's not as though we're going to go back to a Fortress America situation. So those deflationary forces will continue, is what you're saying.
Let's hope they do continue. I think you're right. They're not going to go away. They're going to be scaled back some. The extent to which they're scaled back will determine the extent to which we get a pickup in inflation. But I think I agree with you. It's not going to go away. So we probably are not, just because we've had this new extraordinary expansion of money creation by the Fed recently, and we're going to have much more of that over the year ahead. That doesn't necessarily mean we're going to get high rates of consumer price inflation. We didn't last time after 2008.
So tell us what happened when the coronavirus hit. How much did Fed credit expand? Their balance sheet was up to roughly $5 trillion before all this. What has happened since the coronavirus with this massive monetary stimulus?
So the Fed's balance sheet peaked at $4.5 trillion when they ended the third round of quantitative easing, which was in October 2014. And they left it there for a few years, and then they started quantitative tightening in October 2017. And they actually shrank their assets, their balance sheet, down to something more like $3.7 trillion. So they destroyed something like $750 billion through quantitative tightening. And then the stock market rebelled and it fell 20%, I think, in December 2018. And then the stock market, then the Fed did this extraordinary monetary policy U-turn and eventually stopped doing quantitative tightening. And just very shortly after they ended quantitative tightening, they started their new round of quantitative easing in September, October last year. So since they started the QE4 in September 2019, the Fed's balance sheet's grown from something like $3.7 trillion now to $7.1 trillion. So I think that's a 90% increase in between September and today.
In 9 months or so. Yeah, that's unprecedented to have it go up that much that fast, right?
Right. Again, keep in mind, so just year to date, just this year, the Fed's created $3 trillion. And again, remember that in the first 93 years of their existence, they had only created $900 billion in total up to 2007. Yeah. So it is an extraordinary expansion of the Fed's balance sheet and the amount of credit that the Fed has extended, or the amount of money that they have created.
So you have a name for this. You call this creditism as opposed to capitalism, right?
That's right. I think once dollars were no longer backed by gold, then our economic system evolved from capitalism into creditism. Capitalism was an economic system where it was driven by investment and saving. Businessmen would invest. Some of them would make a profit. They would save that profit, or in other words, accumulate capital, hence capitalism, and repeat. It was pretty slow and difficult, but that's how capitalism worked. That's not the way our system works anymore. The drivers of our economic system have become credit creation and consumption, and more credit creation and more consumption. And that generates much more rapid economic growth, not only in the U.S., but this system has created a global economic boom over the last 3 decades that's literally pulled hundreds of millions of people out of poverty. Yeah. The problem is creditism requires credit growth to survive. And the private sector had hit the point back in 2008 already where it just couldn't take on any more debt because it didn't earn enough income to service the debt that it had borrowed already. And at that point, the government had to jump in.
Okay, we're going to have to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is Richard Duncan. He is the author of several books on the global economic crisis. He also has a newsletter called Macro Watch, of which he's the publisher. You can find out more about it at his website, richardduncaneconomics.com. We'll be back after this.
Become our friend on Facebook. Post your thoughts about our shows and network on our timeline. Visit facebook.com/Voice America.
Are you a homeowner tired of making monthly mortgage payments with little progress towards paying down your principal? Does paying off your home in 5 to 7 years without making larger or more frequent payments sound appealing? Paying off your home in full in 5 to 7 years is really possible thanks to Truth and Equity's Mortgage Equity Optimization System, a money management approach that puts your money to work for you 24/7. If you own a home with some equity, have a decent credit score, and verifiable income, you owe it to yourself to learn more about Truth and Equity's program. There's no need to replace your mortgage or refinance in many cases. The system works for new home purchases as well as current mortgages. Your home is your largest investment. Own it outright in 5 to 7 years. Call Truth and Equity 888-262-5540 or visit truthandequity.com 888-262-5540. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Do you or someone you love have a life insurance policy that's no longer needed or not affordable? Did you know that you can sell your policy for cash? Your reason for buying life insurance has probably changed. Thousands of Americans turn to life insurance settlements to help sell their policies. They act as your representative, getting the highest market offer for you. You've got nothing to lose by simply inquiring. If you're over 64 with $100,000 or more of life insurance, you may already qualify. Call 877-485-6681 to get your free non-binding appraisal or visit fundinglife.com. Life Insurance Settlements. Discover the true value of your life insurance. 877-485-6681. Jordan Goodman is an affiliate. He recognizes quality solutions, forming relationships to help improve the lives of his listeners.
Have you friended us on Facebook yet? Why not? Just go to facebook.com/Voice America or search for the keywords Voice America. Once you are part of our Facebook network, you'll receive daily messages about what's happening with our shows, this week's featured guests, and new happenings at the Voice America Talk Radio Network. And you can add your voice to the always active discussions on our timeline. Just go to facebook.com/Voice America or search for Voice America.
You've been listening to The Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to The Money Answer Show. This is Jordan Goodman, your host. My guest this hour is Richard Duncan. He's the author of several books, one called The Dollar Crisis, another one called The New Depression, and he has a newsletter called Macro Watch. Welcome back to the show, Richard.
Thank you.
Tell people a little bit about the newsletter and the special offer you have for them.
Yes, great. So Macro Watch is a video newsletter. Every couple of weeks I upload a new video. It's essentially me making a PowerPoint presentation describing something important going on in the global economy and how that's likely to affect the financial markets, stocks, bonds, property, currencies, commodities. And so I'd encourage your listeners to visit my website and take a look. If they subscribe, they will receive one new video every couple of weeks for the next year. And they'll also have access to all the videos in the archives. Now more than well above 50 hours of videos and several different courses. So if they visit the website and would like to subscribe, if they click on the subscribe button, they can subscribe at a 50% discount if they will use the discount coupon code ANSWERS.
Very good. Well, thank you very much. And again, the website is richardduncaneconomics.com.
And the code is ANSWERS. Right.
Very good. Okay, so now we talked about creditism. So there's been this massive amount of debt built up and accelerated dramatically in 2020. Not only the American Fed, but the European Central Bank, the Bank of Japan, all around the world. So why couldn't it just go on forever and just keep expanding credit? What could go wrong under the circumstance?
Well, so the situation now represents probably the greatest economic experiment in history. Already the U.S. government has increased its debt this year by $3 trillion, and the Fed has effectively financed that by creating $3 trillion of new money and buying bonds with it, government bonds and mortgage-backed securities. And it's not finished. The stimulus runs out at the end of July, and the government is going to have to pass another very large stimulus bill, or the economy is going to collapse into a depression with such high rates of unemployment and the business sector being devastated. When this crisis started, if the government had not responded as it has, at that time, on March 15th, I published a video called Recession or Depression. And the answer to that question depended entirely on the size and the speed of the government's policy response. I advocated massive fiscal deficit spending, lending money to essentially anyone in the economy who asked to borrow it, and that the Fed should also finance it with money creation. And luckily, they did that. They came through, they acted very quickly. The government effectively provided money to households so they could pay their rent and mortgage. They provided financing for small and medium-sized companies and to large corporations. And consequently, all the banks in the United States still exist. Had they not done that, there would have been such a wave of debt defaults that all of the banks in the United States would no longer exist today. All of the banks would have failed. It was this government intervention that has kept the banking system from collapsing. And
what do you think the next stimulus? The first stimulus was roughly $3 trillion from the government. Now, as you say, everything's running out at the end of July. What do you think the next stimulus should be? The same size?
I think it's going to end up being at least the same size. Perhaps not in the first bill, maybe over a couple of different bills. But by the time we get through this, they will have spent at least $6 trillion, I would imagine, keeping the economy intact. And that's exactly what they had to do. America is a very wealthy country. It can easily afford to spend on this scale. I mean, for instance, in 2019, the GDP last year was roughly, let's say, $21 trillion. And the government debt to GDP, the ratio of debt to GDP, was something like 110%. Well, even if they had to spend $21 trillion to keep the economy from imploding, that would double the size of the debt, so that would have taken the government's debt to GDP up to 220%. Well, Japan's government debt to GDP is already well above that level. It's more like 250, 260% now. Yeah. So we're not going to have to spend anywhere near $21 trillion. That's not what I'm suggesting, but I'm saying we could. So if we have to